We look at deals all the time and we try to analyze them. We call them killing the deals. Every time somebody pitches us a new opportunity or a new property owner calls us and asks to look at their deal, we're trying to kill it. And if we're successful at killing it, it's dead.
Time in the market as a young guy, time is on our side. Meeting as many people as possible, tell them what the heck you're doing, and tell as many people what your vision is. That's a pretty important piece of this that a lot of people miss, is the vision piece. What's your vision? Real estate is a business. What's your vision for your business that you're building?
Yeah, I mean, it's amazing because it's age-old advice. Knock on doors.
Yeah.
As many doors as you knock on. I mean, figurative doors in this case, but it's literally door knocking.
Mm-hmm.
Elijah Long, welcome to Real Estate Development, Land to Legacy.
Thank you so much.
Excellent. So tell the audience, what do you do? What's your focus? What are you known for?
Yeah, totally. So what I do is I raise money for multifamily syndications. I have a network of blue-collar millionaires and really focused on creating an investment vehicle that's tailored to their needs. So at this point, it's syndications, really focused on building out the investor network right now. I've done some deals, but really focused on figuring out what the investors want and building the network.
Excellent. How long have you been doing this?
I've been buying real estate for a number of years, probably 8 years. I started in farmland, actually, because that was just what I knew, and just bought that on my own. I had a waste management business for 11 years, and I sold that here a year ago. That's when I really started to get serious about real estate investing.
Our business, our lives are usually messy, right?
Yeah.
It's never simple and straightforward. A few months ago, I had a guest on this podcast and we started talking about fundraising. And I asked, so what is it that a developer needs to actually be able to successfully fundraise equity for their projects? And he said a lot of things, but in the end, he goes, at the end of the day, you just need to know a lot of people with money. And it sounds like that's how you got to it, right? You knew a lot of people with money, and so you got into a fundraising game. Is that a fair description?
I really started by investing my own and invited others to come along for the ride. This is what I'm doing. You can do it as well if you want. I can make a little bit on the spread as well. The goal is to operate myself. Raising for others at this point is a means to an end.
What type of projects do you prefer? What type of projects do your investors prefer?
Yeah, so typically what we've been focused on in the last little while is value add multifamily. So it's an existing asset. It's anywhere from the 80s to brand new. You go in with some kind of a renovation plan or tax abatement plan or streamlining operations to add value by increasing NOI. It's interesting, this is kind of a development-centric show. I was looking pretty hard at a development deal here a while back, just a 20-unit deal. I was going to do it by myself, and the economics of a 20-unit deal are not great. And basically, there was so much risk on the front end. It was such a small deal. It just didn't pencil for that deal. So we actually passed on that land. But Michigan has some interesting opportunities for development. We can get into that later, but they have actually some pretty good incentives for new development in Michigan. That's where I'm originally from.
Oh, I see. I was going to ask why specifically Michigan. All I know is bad stories from Detroit.
Yeah, don't listen to it. I know I have buddies that have made a lot of money in Detroit.
Nice. Well, that's cool. I do want to hear about that in a little bit, but let me follow up on what you said previously. So 20-unit development, you looked at it, it didn't make sense. Can you go a little bit more into it, why it didn't make sense to you? And I'm presuming it was making sense to the developer who was working on it, right?
Well,
or were you the one to be the developer?
Yeah, I was. It was like a 4 or 5 acre parcel of land, and there was some what's called brownfield incentives that I could have gotten with some of the drainage and the infrastructure going in. Michigan has some incentives for writing some of that stuff off, but it was the previous owner had a site plan put together, some conceptual drawings, and on the surface, it looked like it could be something that would work, but interest rates had already gone up. So this was already in interest rates had already gone up. So it was 22, I think. And valuations were kind of at their peak. The land is a small investment on the scale of some of these deals, but it just didn't pencil. It was just, even with the tax advantages and stuff, it just didn't pencil with one guy taking it down. If you could have brought in a bunch of people and found a way to use more cash so you don't have as much construction financing, maybe, I don't know if it would have worked even then. but it just didn't pencil.
It's a common story. We look at deals all the time and we try to analyze them. We call them killing the deals. Every time somebody pitches us a new opportunity or a new property owner calls us and asks to look at their deal, we're trying to kill it. And if we're successful at killing it, it's dead. We don't go any further. If we cannot kill it, after several iterations, then we proceed with it and do a full feasibility study. It's interesting because there are so many variables that come into play. And a lot of times when we're dealing with an owner who has the land but hasn't ever developed anything or built anything, they start calling around. They call a couple contractors, try to get the most common question, what's the price per foot? And they get the range of prices or cost to build per foot, and they try to build that pro forma, but there's so many things that come into play. And for us, 20 units is hard to pencil. I've looked at multiple multifamily deals. Our sort of rule of thumb is if it's less than 150, it's likely not going to work because it's not enough. It's too small. The overhead is too high. The cost of getting out of the ground is too high. But again, it depends on the site. There's this one deal we recently looked at in Idaho. It's 50 units, detached, built to rent community, and that one worked. So every deal is specific.
Absolutely. That's the wild thing with some of these real estate deals is everything is so deal specific, and so many things can change based on not only the deal itself, but just how it's structured, how it's financed. It makes such a huge difference. Yeah, there's just a ton of variability.
So for a developer who is working on a deal and requires additional equity, what is the process for them to get it presented to you? How do you choose who to talk to, what kind of deals to review, what's involved in a pitch? Whether it's, whether they're presenting to you or to a bunch of other syndicators, family offices, investment banks. Can you describe the process?
For me, I've actually made quite a few investments as an LP with several different operators, like a small nominal amount, testing different operators with my own money before we bring other people's money. Every investment I have made so far has been a test of the operator. So every investment is not only an investment in the deal, but investment in the operator themselves. I'm investing in deals with operators that I want to have a long-term relationship with. Area makes a difference. The business plan and the investment thesis is a big player. So it's not really, that doesn't really answer your question that well, but for me, that's what I'm looking for is people I want to do business with long-term. So that's how I look at stuff. If in a value add play, you're looking at 15% IRR and a 2x equity multiple and a 5-year hold is kind of what we look for. The thing is, every pro forma says that because everybody knows that's what everybody's looking for. And so It means almost next to nothing. Return on equity is maybe a little harder to game, but anytime somebody's got some wild assumptions on an underwriting spreadsheet, we're just hard pass, right?
What would be a wild assumption?
10% rent growth or no expense growth. Expenses, 30% of GPR in expenses on a 70s asset with no renovations. It's like, no, I know you're not going to operate for that. It's baloney. Like, you can have the best spreadsheet in the world, but you put crap in, you're going to get crap out. That's the way I look at it anyway.
Very true.
10% rent growth in Seattle.
Garbage.
Seattle's a crazy market, but the markets we're looking at, it's not realistic.
Seattle is interesting with all of the ups and downs, economically, politically, everything that's going on with downtown area, everything that's going on with Amazon and their growth plans. So yeah, it's going to be interesting to see what happens here. We're still bullish on Seattle, but they're definitely challenging our assumptions every day.
Yeah. So when you guys develop, are you building it, leasing it, and selling it? Or are you building it to hold long term? You mentioned that you work with landowners to help them develop. How does that work? Do you guys build to lease to sell, or how does it look?
So depending on the product, like if it's a condominium development, then obviously it's all for sale. So it's built, sold, cash is distributed. Every deal is different. Some investors come to us and they want to take an active role. They want to be a co-GP, and they want to sit in meetings, they want to approve the plans, they want to be closely involved because they want to learn, or they want to make sure that they've got their finger on the pulse to make sure that we're doing our job. Others are the opposite. They want to be passive. They essentially make us the GP and they become the LP, and they just turn it into a passive investment. And then depending on the type of a project, if it's a rental project, we typically when we build a pro forma, we assume that it's going to be a long-term hold. We underwrite to at least 7 or 10-year hold. But then in the past, it would always end up being flipped, refinanced, or somehow liquidated. So when I build a model, I always assume that it's going to be a long-term hold. And I tell investors, if we get a great offer upon completion, then we'll evaluate it at the time.
Yeah.
And I'm sure nobody's going to mind if we've moved on.
I mean, if you can make your investors a great return and move on to the next one.
Right. Exactly.
Do you guys, I don't want to flip this and make it an interview of you, whatever, but like, what are you guys building units for in Seattle? Just out of curiosity, like, can you get a middle of the road unit done for 200 grand or not? I know it's varies a lot. But.
Is it a high rise? Is it a mid rise? Is it garden style?
Yeah, garden style.
Garden style, I would budget about $250 a foot construction cost.
Wow.
If you go into mid rise and high rise, so you easily go to like $500, $600 a foot. That's why no high rises are being built right now.
Yeah.
Or whatever is being built has been started years ago, but there's virtually no new construction starts.
Yeah.
Unless it's some sort of a subsidized play.
That's crazy.
What about Michigan?
We haven't lived in Michigan for a year, but when I was there, I had a builder telling me that he could build for $150 a square foot. And I don't know quite how, but that's what he said. I would expect closer to 200, honestly, by the time you get your infrastructure in. But, so then you're getting a unit done for, whatever, 180, 200 grand a unit. But if you can, I don't know if you're going to rent it for $2,000 a month either, here, what a rent
Right.
on a $250,000 unit, you're probably renting it for $3,000.
Oh, at least.
Mm-hmm.
I mean, again, depends on location. If you're in Bellevue, you could probably get $5,000 for it. If you're in, I don't know, Renton, Federal Way, yeah, maybe $2,000. Well, even though Renton's getting expensive too.
Yeah.
But anything that's close to the freeway, close to infrastructure, shopping areas is expensive.
Yeah, Bellevue's it's a beautiful city though.
It's just crazy because there's still a lot of demand. I mean, all downtown apartments are like 95, 97% full.
Mm-hmm.
But when we look at new construction and developing for the future, it's hard to get things to pencil because costs are a lot higher than they were even a couple of years ago.
Mm-hmm.
Rents are not growing yet. They will, but it's going to take time.
Mm.
So it's hard to get investors, especially large institutional investors, to commit to a new development in today's environment.
Right.
There's still a lot of institutional investors are still hunting for deals, distressed deals where they could pick it up for pennies on a dollar.
Yeah. Do you feel like I think now is a good time to be buying. I think if you bought in 2021 and 22, you need to be buying right now too. But do you feel like there's still as much capital on the sidelines as there has been?
Oh, there's probably more.
Mm-hmm.
There's a ton of capital on the sidelines. Now, what's making it complicated is the stock market. Whenever stock market tanks, that's when people get jittery and they're not as confident.
Mm-hmm.
But as far as real estate, I think today is the absolute best time to acquire properties and start going through the entitlement process. I mean, look at it this way. An apartment building, a condo building would take at least 18 months, sometimes 2 years to just design and permit.
Yep.
Then 2 more years to build.
Yep.
Then another year to lease up. So you're talking about a 5-year cycle.
Mm-hmm.
And if anybody's thinking that 5 years from now things aren't going to stabilize, I mean, you may as well just sell everything and I don't know,
Hide
buy
in a
gold.
hole.
Like I don't even know what you would do.
Yeah, I think history is going to be very kind to the people that buy in 2025, 2026. New construction starts are just getting ready to drop off a cliff. I mean, I don't know about Seattle specifically. I'm not a Seattle investor, but across the country, starts are plummeting. And it's like, if you can have something come online 6 months after there's no apartments available and everything's 100% full, like you can charge what you want.
Exactly. Exactly. The only thing that's coming online is subsidized housing.
Sure.
They call it affordable. I hate the term affordable. They are affordable, but they're subsidized.
Yeah. Yep.
So, but yeah, those things pencil. But that's
one asset class.
Reason I personally don't like subsidized. I know people make a lot of money in it, but I feel like it's stealing money almost, right, from general public because they get all the public funds and there's so many fees involved and construction costs are high and development fees are high and GC fees are high and all other kinds of fees, financing fees are high. So whoever's doing them is making a ton of money in fees. It costs a lot more money to build affordable housing than commercial market rate housing. So I'm like, how does this even make sense? It seems unfair.
Well, everything the government sticks their paws into, just it's worse and less efficient and more expensive. Part of it.
Exactly, exactly. Yeah, but the barrier of entry is high because it's hard to get into it because you need to know people, you need to have deep pockets, you have to post bonds and whatever else they require. So, but yeah. So for education purposes, what I'd like to educate, the wannabe developers, the less experienced developers who would be listening to this, how do they go about fundraising? If they have this great ambition, whether they're building a duplex, a single family, they ran the numbers, assuming it makes sense financially. How do they go about attracting somebody like you? Like you said, stupid things in the pro forma, I stop talking to them. Fine. No stupid things. Pro forma makes sense. Everything's making sense, but they don't know you. How does one get the foot in the door and find investors like you to pitch the deal?
Oh, that's a tough one. Meetups are great. LinkedIn is really good. I think there's no comparison to in-person events. I was at a best ever conference in Salt Lake City a year ago, and I sat down between a real estate private equity kind of large LP check writer and a family office. I was just introducing myself to everybody, and those guys, I've chatted with them a few times since. And it's just like, yeah, just getting out there and talking to people. Some of these relationships take a long time to actually create something. But time in the market as a young guy, time is on our side. Meeting as many people as possible, tell them what the heck you're doing, and tell as many people what your vision is. That's a pretty important piece of this that a lot of people miss is the vision piece. What's your vision? Real estate is a business. What's your vision for your business that you're building? And if you have a clear vision and who you're speaking to, who you're trying to help and why, that'll resonate with people, and you have to get it out there. So, in this day and age, content creation, I mean, you can get in front of thousands of people quite easily on some of these platforms. So it's just a matter of trying a few things and figuring out what works for you, I think. That's what I've done. So I have a presence on LinkedIn. We have a nice website built out. All my in-person connections were the first people I hit up, business connections from previous business I sold. And it's just a matter of building trust. That's hard to do when you're getting started.
Yeah, I mean, it's amazing because it's age-old advice. Knock on doors.
Yeah.
As many doors as you knock on. I mean, figurative doors in this case, but it's literally door knocking.
Mm-hmm.
Go and meet people. Content creation helps to validate yourself, but at the end of the day, you have to talk to people.
Yeah.
That's why we chose this niche, because we want to be known as somebody who can get the project done from beginning to the end. A lot of times we get calls from architects who say, hey, I've got a client, they don't know what they're doing. You need to get involved. Or we get a realtor that calls us and says, hey, I've got a client that wants to sell this land. And we say, we don't buy land, but if your partner wants to develop it, then let's talk. Yeah. And we'll take care of the broker. And so they put together the arrangement that way. So it's communicating, talking to as many people as you can, and ultimately something works out.
Yeah, I remember, several years ago, I was just interested in the commercial real estate space, and I started calling on properties, and asking dumb questions. And one guy had the patience, and he was very kind. He just had the patience to tell me, the property I was calling on. He says, he asked me a few questions, and he's like, yeah, this one's not for you. He's like, I don't think you want to buy this one. And as a broker, you'd think his job was to sell stuff, right? But it was very kind. He proceeded to talk me out of several more deals. We went down to Sarasota and looked at an apartment deal down there. And actually that one, he liked that one, but we didn't end up doing that one either. But long story short, this was just a broker that I had met, and he took his time and was kind to me. And we ended up partnering on a gas station deal together. That relationship took several years to where we actually trusted each other and knew and liked each other well enough to do something together. But yeah, we ended up partnering on something. And it seems like time and time again, we try to purposefully build these relationships as we go with this end goal in mind. And then it's the relationship that we made on the side on the way on the way, the broker, I wasn't expecting to partner with a broker, but super, super great guy. Yeah, couldn't be happy to be partners with him. So just those relationships along the way that you just don't expect, right?
I love it. And the people who are genuine and transparent and don't mind saying no when they're trying to sell. I mean, I've done this before too, when somebody calls on me with an offer, with a project that they want to do, and I'm like, you don't want to do it. A few years ago, we had a couple of friends actually came to us. They wanted our help developing this property that they bought in Seattle. We did the study. It took us a long time to figure out. It was a difficult site. We looked at remodeling the site. We looked at adding on to it. We looked at knocking it down. Actually, I believe the full demo and reconstruction made more sense. But in the end, that was around COVID time. And in the end, we're like, look, you guys, your property has already appreciated. I think they bought it right before COVID. And we were talking, I want to say end of 2020, maybe beginning of 2021. And we're like, we would love to do this deal. We would love to build something new there. But we're like, just keep it.
Mm-hmm.
Either keep it, cash flow it, or sell it. You already made money on it.
Yeah.
It would be irresponsible of me to convince you to develop it and take on additional risk when it's not necessary.
Yeah.
And I'm like, I don't know how many people would have just taken the money.
Yeah.
But
in hindsight, talking about COVID, there was such a crazy time, but I think that there was definitely some opportunities. If you bought right after COVID, when nobody was doing anything, nobody knew whether they were going to live or die, just buying real estate in that dip and holding on to it, I actually was able to take advantage of that on two different deals. The one I bought right after COVID, sold it within 4 or 5 months, and then bought another one and sold that one in probably 6 or 7 months. Just kind of rode that wave and got really lucky. Neither one of those deals were really what I wanted to do long term. Moved them and took some profit and moved them down the road. But
were you the LP there or a GP?
Those were small deals. They were just, one was a duplex and one was a single family. Long story short, decided that the larger multifamily was the route I wanted to go. So just moved those. But yeah.
Excellent. So your favorite asset class sounds like multifamily, podium style, garden style. What's your favorite?
The ones I'm in are all mostly garden style. There's one that's a high rise that I'm in as an LP. And yeah, those are what I'm comfortable with. I understand well enough. I'm working on some underwriting, learning how to underwrite better, building an underwriting model right now, just for the sake of understanding how these specific properties work and operate, where the profit is. So yeah, that's the asset class I'm in.
Gotcha. And what's your sort of target check size or range, if you don't mind?
Right. So right now I'm doing some smaller LP positions, 50 to 100,000. And like I mentioned, I'm looking for operators I want to do business with long term, with the end goal of, my end goal is to operate myself. So figure out how some of these operators work, what they do right, what they do wrong, and learn from those. So
perfect. And so let's talk about Michigan again. I know you're from the area. You like that market. There's a lot of opportunities. Would you look at other parts of the country, other parts of the world? How do you determine that certain geography is right for you?
Yeah. Michigan's not a super exciting market. It's sort of flat, or population growth is pretty flat. There are pockets that are exciting. I think Detroit is poised for a pretty good comeback. Certain parts of it. There's been a lot of investment in Detroit, believe it or not. A lot of businesses spending some money there. And Grand Rapids is a very solid market. The dream for me is to invest in Michigan. It's home for me. But I have LP investments kind of across the Sunbelt. And then I just actually made one in the Midwest on the Indiana side in Louisville, with a friend of mine there that I'm testing the waters a little to see whether there's a partnership in the making there or not. But I've invested the most in the Savannah, Charleston area at this point. I like those markets, but fairly open right now.
Nice. Interesting. One question I like to ask my guests is, tell me a horror story. Tell me something that went horribly wrong that taught you a life lesson.
Well, I've got horror stories, but they're actually from a previous business. They're not actually real estate. So far, I've never lost money on a real estate deal. Knock on wood. I had a couple deals that I purchased right after COVID. I was going to speculate, and I thought steel prices were going to go up and these type of implements were going to be in high demand. But I ended up buying too late, and I actually ended up selling for a small loss. The lesson for me was just to never, ever speculate. There's a certain amount of speculation in a value add deal. I understand that. There's a certain amount of speculation in a development deal. But there's the cash flow to back it up too, right? There's history to back it up. I'm not really a big Bitcoin or gold guy. Like, I'd rather have something solid that cash flows and multiple exit plans. I think that's important. So, rather than buying something, just holding it and hoping it goes up in value, that's just not my style investing.
Thank you. That's good advice. Anything else, Eli, that we should be talking about that we haven't covered yet?
I would love if any of your listeners are interested, I'm really intrigued right now with this thought of buying assets with cash. There's some big institutions that do it, but especially in the real estate environment that we're in right now, buying with cash, wipe out most of your risk up front. You've got most of the complexity and the things that take all the time are all tied to your leverage on a multifamily deal. If you can, with value add, you can buy an operating asset that's already cash flowing with cash and refi your investors out in a couple of years. A refinance is not a taxable event. I don't think the yield is quite as much as on a fully levered deal. But I think there's opportunity there. I'd love to chat with somebody if they're interested in talking about that. It's a product or an investment vehicle that I've considered offering as a part of Legacy Way Holdings. So definitely reach out.
Excellent. I mean, it's very similar to a fund that we recently announced that we're putting together right now for special situations. It's basically a form of a distressed asset fund to acquire properties in financial distress.
Mm-hmm.
There are a lot of new construction buildings right now, townhomes, condominiums, apartments that are not performing and that are sitting in receiverships in this limbo.
Mm-hmm.
They're not being foreclosed on, but they're financially distressed. Mm-hmm. And yeah, we're looking at putting together an equity fund specifically to buy them out in cash, stabilizing them, renting them out, and then after a little while, getting a loan to get some capital returned back to the investors and then holding them for the next 3 to 5 years.
Totally.
For mostly capital appreciation purposes.
Yep. I love it.
Excellent.
I think so.
Right. Hey, thank you for joining me. This was an awesome conversation. I love it. Super easy, conversational. Let's do it again. And thank you.
Thank you so much.
Oh, before I forget, how does one get a hold of you? What's your contact information, website?
If you're interested in learning more about Legacy Way Holdings, go to legacywayholdings.com. There's a form in the contact section. Fill it out and sign up to our newsletter. We'll teach you everything we know about multifamily and about investing in general. You can learn about what we do and how we do it and why we do it.
And the link is going to be down in the show notes so that anybody could access it and get a hold of you.
Awesome.
Thanks again, man.
Thanks, Gene.